Right now, while most retail investors are waiting for clear signals that the market is safe again, smart money is already moving. History shows that major market rallies don't begin when confidence is high. They begin when uncertainty is still in the air, when headlines are mixed, and when the average investor feels cautious. By the time economic data looks strong and the news turns positive, institutional investors have often already positioned themselves. The real opportunity isn't chasing the rally once it's obvious. The real opportunity is understanding what smart money is quietly accumulating before the next upswing begins. When we talk about smart money, we're referring to institutional investors, hedge funds, pension funds, private equity firms, and billionaire investors with access to deep research and insider-level financial analysis. Think about investors like Warren Buffett, who built his fortune by buying strong companies during periods of fear. These investors don't react emotionally to short-term volatility. They study long-term cycles, analyze balance sheets, and move capital strategically. They don't chase hype, they position early. So what are they buying right now? First, smart money is focusing heavily on high-quality, large-cap stocks that have been temporarily discounted. During uncertain periods, strong companies often get sold along with weaker ones. That creates opportunity. Institutions are targeting businesses with strong cash flow, manageable debt, consistent earnings growth, and competitive advantages. Companies inside major indexes like the S&P 500 that show resilience during slower economic growth tend to lead once expansion resumes. Smart money understands that quality compounds over time, especially when purchased at attractive valuations. Second, infrastructure and industrial stocks are quietly gaining attention. The United States continues to invest heavily in domestic production, manufacturing, transportation, and clean energy infrastructure. Government-backed spending programs are pushing billions of dollars into construction projects, semiconductor plants, grid modernization, and supply chain reshoring. Institutional investors are looking at engineering firms, heavy equipment manufacturers, raw material suppliers, and industrial automation companies. These sectors historically perform well during early economic recoveries because they directly benefit from capital investment cycles. When growth accelerates, infrastructure spending accelerates with it. Energy is another strategic focus, but not in the way many people expect. While traditional oil and gas companies remain profitable, smart money is diversifying into energy transition plays. Electrification, battery storage, and renewable infrastructure are long-term structural trends. Institutions are allocating capital into companies involved in lithium mining, solar development, wind energy expansion, and power grid upgrades. The shift toward cleaner and more resilient energy systems isn't a short-term trend. It's a decades-long transformation. Smart money invests where long-term demand is predictable. Technology remains a core pillar of institutional positioning, but with a more selective approach than in previous cycles. Instead of chasing speculative startups, smart money is concentrating on profitable technology giants and companies building the foundation of artificial intelligence. For example, companies like NVIDIA have become central players by supplying advanced semiconductors required for AI computing and data centers. Rather than betting purely on consumer-facing applications, institutional investors often prefer the picks and shovels strategy, investing in the infrastructure that powers innovation. Data centers, cloud computing providers, semiconductor manufacturers, and cybersecurity firms are all part of this ecosystem. Cybersecurity in particular is seeing sustained interest. As businesses digitize operations and governments strengthen national security frameworks, digital protection becomes essential, not optional. Recurring revenue software companies with long-term enterprise contracts provide predictable cash flow, which is especially attractive in uncertain macroeconomic conditions. Smart money favors stability alongside growth. Financial stocks are also on the radar, especially large U.S. banks with strong capital reserves and diversified revenue streams. After periods of interest rate hikes and tighter credit conditions, stronger banks often consolidate market share. Institutional investors analyze loan growth, net interest margins, and deposit trends carefully. When economic conditions stabilize, financially sound banks can benefit significantly from renewed lending activity. Another important strategy smart money uses right now is selective patience. Contrary to popular belief, institutions don't stay fully invested at all times. Many funds increase cash allocations during volatile periods. This isn't fear, it's strategy. Holding cash provides flexibility to take advantage of sudden market pullbacks. When sharp corrections create discounts, institutions deploy capital quickly. Liquidity is power. So what can retail investors learn from this? The first lesson is to prioritize financial strength over hype. Focus on companies with durable earnings, low debt relative to cash flow, and strong competitive positioning. The second lesson is to think in cycles. Markets are forward-looking. By the time a recession officially ends or GDP data turns positive, stocks have often already moved higher. Smart money buys when sentiment is weak and valuations are reasonable. The third lesson is diversification across structural themes. Infrastructure modernization, artificial intelligence, energy transition, and industrial reshoring are not short-term trades, they are multi-year shifts. It's also important to understand that the next upswing may not look like the last one. The post-pandemic rally was fueled by stimulus checks, near-zero interest rates, and rapid liquidity injections. The next expansion may be driven more by productivity gains from automation, AI integration, domestic manufacturing growth, and infrastructure investment. Smart money is preparing for that shift now. Historically, some of the strongest gains in the stock market have come during the early stages of recovery, when fear is still present. Investors who wait for perfect clarity often miss the initial breakout phase. Institutions understand that markets move ahead of economic headlines. They analyze leading indicators, earnings revisions, and capital flow trends to position early. Right now, volatility should not automatically be seen as a threat. In many cases, volatility represents opportunity. Smart money views pullbacks as entry points into long-term themes. They build positions gradually, manage risk carefully, and maintain discipline even when news cycles fluctuate daily. The key takeaway is simple but powerful. Smart money is not waiting for the upswing to begin. It is preparing for it. By accumulating quality stocks, infrastructure plays, AI leaders, energy transition companies, and financially strong institutions, they are positioning ahead of optimism. The next market rally won't start with a loud announcement. It will begin quietly, likely when confidence is still mixed. And when headlines finally declare that a new bull phase has arrived, the biggest gains may already be underway. The question isn't whether another upswing will happen. Markets move in cycles. They always have. The real question is whether you'll be positioned before it begins or chasing it after it's already in motion. Smart money has made its decision. Now it's your move.